Hey, sister leaders, this is Dr. Karen Hills Pruden, and of course, I have another awesome sister leader for you. I have with me today Brandy Hubbard, and Brandy, can you tell the sister leaders community how awesome you are and what you do in this space called life?
Yes, Dr. Karen, I'm so happy to be on here with you today. So, first of all, I just want to thank you for this amazing opportunity. I'm just so excited to be connected with you because you are amazing. But so basically, Dr. Karen, I have been in the financial services industry for over 24 years. The company that I represent is American Classic Agency, and we help people to protect their income, eliminate debt, and create legacies.
I love that. Protect their income, eliminate debt, and what legacy?
Create legacies.
Create legacy. Absolutely. You got to tell us a little bit more. You got to break that down. So, can we just take it step by step? So, protect their income. Tell us about that.
Yes. It's interesting, Dr. Karen, because so many people, right? They have car insurance, they have homeowners insurance. I mean, everything we get these days, you're getting insurance. But the main thing that I find that people don't do is protect their biggest asset. And what I mean by that, usually when I ask people, like, what is your biggest asset? They may come and tell me, well, my house. But in reality, it's not. It's you, your life, your ability to earn an income. Because if you can't earn an income, you can't pay for that house, right? So protect their income is protecting them from financial devastation. So I'm going to give you an example. Most people don't realize just how valuable their life really is, right? So I'm going to use a married couple as an example. So let's say I'm married. My husband makes, even if he makes, let's say, $50,000 a year, right? And let's say I have small children. Let's say my oldest may be 5, or, as his wife, I'm looking for his income to come in the house for at least another 13 years until that child is 18, right? But on top of that, we might say 21 because we want the child to maybe go to college, right? So when I do that, if I whip out my calculator right quick, you figure for another 16 years. So that's 50,000 times 16, which is $800,000. So I'm expecting $800,000 to come into that household at least until my child is of 21, right? Most people don't do that. Why? Because we weren't taught that, especially in communities of color. The main thing we're taught is just, get enough to bury your loved one. No, we need to protect our income because what's going to happen, which most people don't think about, is God forbid that husband doesn't come home tomorrow. And I'm living in a $400,000, $500,000 house in the suburbs. But now that I don't have that income, guess what? My zip code may have to change. See, people don't think about that. My children at this point may now have to go to another school because I can't afford to keep my standard of living or my lifestyle. I have not protected that income. So it's just so important. Like, I'm so passionate about this because I'm so tired of seeing GoFundMe's. You know what I'm saying? We need to put GoFundMe's to rest. I want people to understand just how valuable their life is. And I want communities to understand the importance of protecting that income so that they can protect their family. Hopefully you love your family, right? So you don't want to see your family out on the street. You don't want to see them, your wife facing foreclosure. You don't want any of these things to happen. So when we say protect that income, that's exactly what we mean. And not just for married couples, though, Dr. Karen. Even if you're single, right? Let's say you're not married, you don't have any kids, you don't have a spouse. but you still care about yourself, right? So let's say, God forbid, you're in a terrible car accident and you can't work for 6 months. What are you going to do? We need you to protect that income. Well, how can you do that? Back in the day, life insurance used to be for just a death benefit. But today, it's like we like to call it life insurance. You don't have to die to use. So, in the event of a catastrophic accident or injury, you'll be able to access that death benefit while you're still living, be able to pay your rent if you just rent an apartment, or pay your mortgage. So what we're doing is preventing foreclosure, or we're preventing homelessness. It gets deep, right? It gets deep. People don't think about that.
I love that. I love that. And you're right. And it is a um mindset change, but I'm wondering, where do we start teaching that? At what point in one's life do we start talking about that? Is that before they go off to college? Is that before high school? At what point in our lives do we start talking to our young people so that they will understand the importance of life insurance as not being just a death benefit? You have any idea of when we should introduce that conversation to our family?
Let me tell you, Dr. Karen, that's a great question. I start with my kids. My 10-year-old grandson can come in here and tell you that my Mima, she teaches me about investment. And I have those conversations when they're young. And of course, you tailor the conversation to the age group, right? But honestly, I think they should have financial classes in school. To be honest, I wish there was a way. Well, that's an idea, Dr. Karen. We might be able to talk about that later, right? But I wish there was a way we can get financial literacy in elementary school. Just start with basics. Teach them about credit, the importance of credit, the importance of remaining out of debt, just giving them the basics, right? And then on up through middle and high school, because I had those conversations with my son to the point where at the age of 21, he was able to go out and buy his first home, a single family home at that. Okay, 3 bedrooms, 2 bathrooms, but he understood it. And I think if we have those conversations early on, it can help prevent so much of, the debt crisis that we're facing, right? You have so many people too who are in college who have $300,000 worth of student loan debt, right? They're starting their life off that way. You know what I mean? So we're even showing people how to get out of debt with a life insurance policy, including a 30-year mortgage in 9 years or less. That's another conversation we can have.
I love that. So that is a good segue into your second pillar, what you were talking about, eliminating debt, because I know that there is good debt, and then there is not so good debt. And so can you talk about what is good debt? And what I mean by good debt is, if you're raised to own a home and different things, then a mortgage payment is considered good debt. And anything that appreciates, I have been raised, and correct me if I'm wrong, that that's good debt. But if it depreciates, it may not so good debt. Credit cards and debts that people acquire for reasons and things that don't appreciate may be bad debt, even though it may be necessary for us to have certain things at certain times, but it's not the best type of debt. And so I know you help people eliminate debt, but let's talk about debt, just the existence of debt as a whole, because we do know that to substantiate ourselves here and in our environments, that we have to take on certain types of debt. So is there a good debt and is there bad debt?
That's a good question. On the road, Dr. Karen. Okay. So, I think the one important thing too, I want to start off with is teaching debt management, right? because most people don't realize when they get a credit card, the average person don't realize that technically you really should only spend up to 30% of the amount you're given.
What?
Yes, that's how you keep your credit scores high, right? So a ham sandwich, right? So most people don't realize, right, that if they get a $3,000 limit, guess how much they should spend, right? 30% is $300. You should keep a $3,000 credit card at $300 limit, the highest, which is crazy, right? Because it's like, why give me 3,000 if I can only spend 300, right? So that's one point, just being able to teach people how to utilize credit cards to the point where they're just creating that credit score, let's say, that they really need, right? Because no debt is just as bad as having bad debt.
Yeah.
Right? So what you want to do is when you do get those credit cards, not only keep it at under 30%, pay it on time. Okay. Because here's another point. Even you know how some credit cards give you like a 7-day grace, or some loans, let me put it that way. Some even your car note, right? They may have like a 7-day grace. No, you don't even want to use that grace period, because what'll happen is, let's say my car note is due on the 10th of every month, and my 7-day grace means I could pay it by the 17th. If I pay it on the 17th every month, I'm telling the creditors that I pay my debt late, in the sense that I'm always utilizing that additional 7 days, right? So that's what it's being seen as to the creditors. I need to, if it's due on the 15th, I need to pay it before or by the 15th. So that's another thing, right? As you continue to use your credit cards, a good habit is, if I go out and have a shopping spree, just make sure I pay that debt off within 30 days so that I'm not paying the interest, right? So all these little tips can help you manage that debt, so to speak, right? And your mortgage payments, all of these things, if you just pay a little bit more, I don't care if it's $25 more a month, right, to go towards the principal of these debt. Because if with those revolving credit cards, it's an unending cycle, right? If you pay the minimum, which a lot of people do, Dr. Karen, a lot of people just pay that minimum. They'll have that debt for 30 years. You get what I'm saying? And it could just be $1,000 credit card. But if I'm just paying $25 a month, my minimum, I'm in debt for 30 more years. So, trying to prevent people from getting into debt, making sure that the good debt, like you said, the mortgage, anything that's going to build equity, that's good debt. If it's a liability, right? Even it's really a liability to a certain degree, right? So we just want to make sure that we learn these things. And I usually do workshops to help people, to educate them on how to do good debt management, how to put budget, control their budget with budget sheets. Because I'm gonna tell you, the main problem I run into when I sit down with families, they'll go to Starbucks, right, and buy that $5 coffee, and then they'll go to 7-Eleven and get a donut or whatever. And what they're not realizing is that $5 here, that $10 there, that $20 there. By the end of the week, they spend $500.
All right, now you done stepped on my foot. Now you can get off my foot now.
I had that conversation with my son, right? I'm like, we need to sit down and look at what's going on. So when we sat down and looked at it, by the end of the month, he had wasted like $1,400. $1,400 just running out to eat, stopping and getting candy, stopping and getting coffee, eating out for lunch every day. I know it's not easy to take lunch with you every day, but put a plan in place. Maybe you take lunch, Monday through Thursday or Tuesday through Thursday, because sometimes Mondays is rough, right? You running out that house.
Mhm.
So I'm gonna buy lunch on Monday and maybe treat myself on Friday. Just those little tips. Take my lunch Tuesday through Thursday. You'll save almost an extra $200-300 a month just doing that. Imagine what you could take that money and put it and invest it somewhere for your future. So little things like that I kind of teach in the little workshops that we do for financial literacy.
I love that. So my next question before we move into legacy is that a lot of times you find out that people choose a career because it is akin to some type of pain point they went in through in life or experience, or they know someone who experienced. And so tell me how you fell into your financial career. Is it associated with any type of pain point or someone you know who experienced a pain point? So why you? Why finance? Why are you in this industry and have been for, I believe, 24 years, you said?
Right. That's a good question too. Woo, girl. Look, I ain't trying to get no. Look, I'm not trying to throw nobody under the bus, but so I'm gonna say it like this. So years ago, before becoming into financial services, I was born and raised in New York City, and one of the things I love about New York City is a lot of the high schools, they have programs and trade programs in schools. Like you could take pre-law, you can take computer science. In your last year of high school, you actually intern, or your last 2 years, you can intern at these different um, corporations, depending on what route you want to take, which I thought was awesome. So at one point, I thought I wanted to be a lawyer
Okay.
until I actually worked in the law firm, right? So, but I actually stayed there almost 15 years, right? And it was because, the pay was good. I started out wanting to be an attorney, but I always like to shoot for the best, right? So, what I mean by that is if I wanted to stay an attorney, I was going to be on the path of partnership. That would have been what I wanted to do.
Mhm.
And girl, when I was at that law firm and they had showers and couches, so you could like work all night, take a shower, don't even go home. I was like, okay, that right there was enough for me. I was like, I'm not trying to live here. I can't even go home and kiss my family. It was too much.
Mhm.
And so I was like, I don't think this is for me. So I always was very personable, right? Like I never met a stranger. Like even I'll never forget my elementary school teacher, because in New York it's very multicultural.
Mhm.
And that's what I miss about New York. Like we had people of Asian descent, Black, Indian, I mean, Nigerian, like all cultures. So, I guess she felt like, well, if I sit Brandy next to the Chinese girl, she'll be quiet.
No, that
But
didn't work out, huh?
no, it ain't work out. So I sit next to, and that be my best friend. Anybody she sat me next to, they became my friend. She said, well, let me sit her next to a boy. They became my friend. So she was like, you know what? If I sat you next to the wall, you would make the wall your friend.
I
But
love it.
I'm saying that to say I always love people and I loved helping people. And I would see certain things about, families. Back then they didn't have GoFundMe, right?
Mhm.
But I would see like, my family, like if anybody passed away, I hear, my grandma and the parents, everybody trying to put together a car wash or cooking dinners to collect money to bury your loved one.
Mhm.
You know what I'm saying? And I
Mhm.
was like, think it's supposed to be like this,
Mhm.
And, so I was like, I need to check into that because I love helping people. I love people in general. So let me try to figure out what kind of sales or anything helping people that I could do. And it just happened to fall into my lap. I ran into my mentor that's still my mentor now. He's actually the president of our agency now.
Awesome.
And he was like, Brandy, I'm gonna take you under my wing and we're gonna do this. And so when we started, on this career path, and I started getting in front of families and, just really seeing like where they were, I became so passionate about it, and I love helping everybody, but like in communities of color, there's so many misconceptions about, life insurance. We need to clear that up. And I'm hoping that when people know better, Miss Dr. Karen, they're going to do better because, you should hear some of the stuff that I hear when I sit down with some families. Like I had a 54-year-old man tell me he didn't need it because his mother had insurance on him. It's like,
I'm sorry.
a grown man. And I was like, well, how much coverage does she have on you? He didn't know.
Yep.
Is it still in force? Because here's the kicker. You thought you laughed when I said that. How about his 80-something-year-old mother has dementia?
Oh, wow.
So how do you even know
That she's still paying the
that
bill?
she's still paying on it? You know what I'm saying?
Mm-hmm.
So we had that conversation, and sometimes, it's more than just insurance, Dr. Karen, because sometimes, especially with Black men, like I'll sit with them and they haven't been to the doctor in 5 years. I'm like, how you don't have high blood pressure?
Mm-hmm.
Haven't been to the doctor, right?
Yeah.
So, because I've seen clients, like one of my clients, unfortunately, her husband just passed out in the bathroom and died of a massive heart attack because he had high blood pressure and didn't know it.
Mm-hmm.
I have so many stories I could share with you all where, we're helping people on even a deeper level. I sit down with people and they tell me, oh yeah, the doctor say I had a little bit of sugar, but I don't take that medicine. Or they say I have high blood pressure, but I don't take that medicine. I feel fine. And it's like, that's why they call high blood pressure the silent killer,
Mm-hmm.
because you don't have any symptoms. And then you could just have a massive stroke or massive heart attack out of anywhere. So when I look at what I'm doing, I'm passionate about it on so many different levels. And I want to help our community so much because we need to get them out of the misconception that life insurance is bad. Some people say they don't want to profit from somebody's death. No, we don't want anyone to pass away.
Mm-hmm.
It's not about profiting from their death. We're going back to protecting your income, protecting your family, putting your family in a position where life can be better, right?
Yeah.
So we're just trying to educate them on trying to think differently and understand how powerful life insurance is. A vehicle that can help not only protect your income and eliminate debt, but create wealth and create a legacy and close the income gap.
Mm-hmm.
Because Dr. Karen, if your mother or father knew all the benefits of life insurance, right, when they were coming up, and let's say, I don't know if they're still alive,
Mm-hmm.
but when they did pass away, if they left you $1 million, would your life have been different?
Absolutely.
That's the whole point. Even if it wasn't $1 million, even if they left you 200,000, could that have maybe helped you start the business you wanted to start? Help send your kids to a different college? You get what I'm saying?
Yeah.
So we gotta think differently. We gotta do better. And hopefully, when I'm out here in the community and educating and doing these workshops, getting the message out there so that if people know better, they'll do better. And I need help. We need some sharp people to join our team to help us on this mission, because it's an educational movement and I need some sharp people. You can keep doing what you're doing, right? Keep your 9 to 5, But we have a lot of people that work with us on a part-time basis, nurses, teachers, people from different professions that love what we're doing as far as educating, right? It's helping them to create wealth too, right? But some people love what they're doing, and that's fine, but they see the importance of what we're trying to do. So
I love that. And so that is a perfect segue into your third point, which you talked about creating legacy. And so, and when I think about legacy, I think about something that is going to live beyond us, something that we prepare for. There is no legacy if someone didn't prepare for it, prepare to leave something. And so, tell us a little bit about creating legacy in terms of finances, and then also if you have any examples of how getting insurance can help create a legacy.
absolutely. So let me see where I want to start with this. Okay. So oftentimes when our loved ones pass away, unfortunately, they leave debt. They don't leave a legacy, right? So what we're trying to help people to appreciate is how to utilize the life insurance policy properly. We want to make sure that the policy is set up properly. Everybody have different goals, right? Um, everybody has different circumstances or family dynamics. So an agent, I like to call myself an agent for change, an agent for life, because a lot of times people will call up an insurance or they'll see like a life insurance commercial on TV. Get such and such for $20, right? And or they'll call them and they'll just give them anything, right? I don't believe in that. I want to sit down with you, see what your dynamics are. Do you own a home? Are you married? Do you have children? If you were to create a legacy, who would that be for? I need to get questions. I need to see what's going on in your life so we could structure that policy, right? Right. Now, by doing that, when we prepare the plan, we have one particular policy that does all of that. So it'll protect your income, it helps you to eliminate debt, and it helps you to create that legacy. So in doing that, you might say, well, I want to leave my grandkids money so that they can not only go to college, but they could buy their first home. um you're passing it down for generations, right? So that your children or your grandchildren don't have to struggle like you did, right? So when you build up that policy, you might get 1 million, you might get 2 million, or dollars worth of coverage, or we want to make sure it fits within your budget too. We go over all of that, right? You might want to do 1 million, but your budget might be screaming 500,000. Okay. But 500,000 is still better than nothing, right?
Yeah.
So we kind of, and then we'll get that 500,000 in place, and then we'll show them how they could work towards the million that they want. But the part of creating legacy comes in the cash value portion of the policy, right? So when you pay for insurance, you're paying to have the protection, but the cash value, you can do what we call overfund that policy, in a sense, where you're creating your own bank. Like a lot of people are seeing YouTube videos and things on social media where they're talking about infinite banking and creating your own bank. So what they mean by that is, let's say I was to put 20 grand in a savings account. Now, we all know that a savings account may pay 0.5% of interest.
Mhm.
I was talking to a young lady who's a client of mine who said she had 25 grand in her savings account, and at the end of the year, she made $12.50. That's not creating a legacy. That's not creating wealth, right? So we're helping people to appreciate, yes, keep some money in your savings account for a rainy day. You may not need 25 grand in there for that rainy day, but at least 3 months of income in case something happens, right? So 3 to 6 months, sometimes I shoot for 6 months if it depending on how much they have. But if you put that same amount and you drop that into a cash value policy, now you're getting maybe 6%, 7%, 8% interest on that money, right? So that's going to put you in a position to create wealth better, right? But here's the kicker. Okay, I'm gonna lean in on this one. If they don't remember anything else that I say from today, these are the two things that I want you to remember.
Okay.
One is called the Rule of 72. Okay. The Rule of 72 was used by the Census Bureau, where it helped them to understand how quickly the population doubled. Well, financial services said, wait a minute, this same formula can help us in determining how quickly your money can double. Now, why is that important? Because if I have my money in a vehicle that's only paying, let's say, 3% interest, okay, we're going to use that for math purposes. What you're going to do is whatever vehicle you have your money in, you're going to take that. So if it's 3%, you're going to take 3% and divide it into 72. So 72 divided by 3 is 24. So if you have your money in a vehicle that's paying 3% interest, it's going to take you 24 years for your money to double.
That's a long time.
That's a long time. Now, let's make it more interesting. If you have your money in a savings account that's paying 0.5%, 72 divided by 0.5% is what? 144 years. Did you hear me? I said,
144
no,
years.
I'm just saying, yeah. 144 years. Now, I don't know about you, but I don't have 144 years for my money to double.
Mm-hmm.
So, that's one thing I want people to understand. And then here's the other thing, Dr. Karen. People will have their money in a 401k or a 403b or a TSP, any of those things, and they set it up 30 years ago when they first started working there and never looked at it again. They don't really know how to allocate those funds because they give you this sheet of paper, right? And they ask you to pick where you want those funds. You that,
Yeah.
right? I mean, even as a licensed agent, I'd be like, it could be overwhelming.
Mm-hmm.
But the problem with that is people just kind of do eeny, meeny, gypsalini. They put that money there, right? And in 5 years, when the market does bad, they lost $50,000 of their 401k. And then the worst part about it is they don't move it. They let it stay there, right? And then next thing you know, when the market crashed, like I know some people who lost so much money a couple of years ago that they can't even retire right now. Mm-hmm. So that's why it's important to sit down with someone like myself, right? Who can help you, even though, I don't have anything to do with necessarily, I don't get paid for that, right? But my heart and my passion wants you to do well, right? Whether I get paid for it or not. So a lot of times when I get clients, I'll ask them, let me see your 401k. Let's look at it, right? And we'll look at where it's being allocated, and I'll tell them to make sure they watch it. These are some of the, indexes that have done well, right? And then when they get to a certain age, when you start hitting over 55 and you're close to retirement, we may have had some things in high risk, but we need to move that to something a little less risky now, because the last thing you need to do is lose $200,000 and you're 60.
Mhm.
So all those little tidbits, right? So just teaching them that, because I bet you when people see this podcast, it's going to be so many on there who started their 401k or TSP and all years ago and never looked at it again. You need to look at that at least once a year. See how it's performing. You may need to switch your allocations because you want to maximize, right? What you're getting, because retirement will be here before you know it, right? And then we also have programs where you could get the benefit of stock market gains without ever losing. And how they're able to do that is, let's say the market's at 10%, right? Well, we might give you 8 of that 10%, 8% of the 10%. But then when the market crashes or loses and everybody else is losing, you stay at what we call a 0% floor. So that means you're not losing, but you're not gaining at that time period either. But wouldn't you say it's better for your 200,000 to remain 200,000? Then when the market picks back up, you start gaining again. So we have, options like that as well. So that was the one point. I know that was a lot. I know that was a mouthful.
I love
I want you to remember the rule of 72.
Yeah. Oh, yeah. I got that down. Rule of 72. How quickly your money can double is what I wrote in my notes. So we love this. We love this. So as we close up this podcast, can you tell the sister leaders community how they can be in touch with you, reach out to you, be connected to you if they want to know more about all of the things that you talked about, protecting on their income, eliminating debt, and creating legacy, anything about insurance? Tell them how they can connect with you.
Okay. And before I do that, I'm going to say this second piece that I wanted everybody to remember, right?
Okay.
When you have a life insurance policy, the way you're creating wealth is this, and most people don't know this. Let's say I have that $20,000 sitting in my life insurance policy, and I take it out as a loan. You always take it out as a loan because you don't want to create a taxable event, right? If you withdraw it, that creates a taxable event. But if you take it out as a loan, here's the kicker that most people don't understand. Your policy is being held as collateral. That $20,000 that you're taking as a loan comes from the actual insurance company. Your $20,000 remains in your policy and continues to receive interest. Awesome. Isn't that amazing?
Awesome. Absolutely.
So that's how you create wealth. You're able to use your money twice. And then you have the ability to decide, do I pay it back or do I not pay it back? We encourage to pay it back, but if you didn't pay it back, right? Like, unlike if you were to borrow from a bank, your credit gets bad and everything happens, right? But with an insurance company, if you don't pay it back, they take it from your death benefit. So let's say you had a $200,000 policy, right? Instead of your family getting $200,000, they may get $180,000. But hey, that's still good, right? So I just wanted to throw that in before we end it. But I'm so excited. I want to thank you so much for this amazing opportunity to sit here with you, Dr. Karen. I love you so much. And I'm so happy we're connected. But the way they can reach me is Brandy Hubbard, right? They can feel free to text me, call me, 443-864-7337. Once again, that's 443-864-7337. brandyhubbard.com. I change that up sometimes. Sometimes I'll have information about getting products. Sometimes I'll have information about joining us because we need the help, right? You can follow me on Facebook. You can follow me on LinkedIn. Brandy Hubbard everywhere.
Awesome. Awesome. And I'm sure some people will reach out. Well, this has been purely educational. If you can see my little pad I got here to the right, I got all kinds of notes here. Because of course, Karen, 20-year-old Karen wasn't thinking about legacy, and 20-year-old Karen really wasn't thinking about debt either. But now that I'm closer to 60, I in the last maybe 30 years or so, have really been focused on, my financial health. And all those things that are part of financial health, debt elimination, protecting income. I'm now getting better with even insurance, because I think I was underinsured, because my insurance was tied to employment. And so now I've actually took care of that as well. And so working on my sweetie to make sure that his stuff balances out my stuff. And so I am one of those people who have converted, who didn't think about the things that you're talking about, who is now extremely interested in what you're talking about, and now can appreciate being educated on why I need to have these things in place. And so I'm sure I'm not the only sister leader who has had a deficit in that area, but as long
Right.
as we have breath in our body, we can always correct it. We have an opportunity to change it as long as we're still here. And so I'm excited about those who are going to reach out to you. And so I want to thank you. And so for the Sister Leaders community, make sure you get in contact with Brandy Hubbard, and I will list her full bio with this recording. And it will live on the YouTube channel, and then we will upload it with Apple and everything when we do our batch upload. But Brandy, we are excited about the future conversations that people are going to have with you, and you'll see more of Brandy in the Sister Leaders community. So I'm not going to let the cat out of the bag right now, but she's not going anywhere. And
Can
so,
I say one more thing, Dr. Karen? Just one
absolutely.
more thing, because you just brought something to my mind.
Go ahead.
It's so important to have insurance outside of your employment.
Mhm.
I'm not going to go through all the reasons, but one, what if you lose your job? What if you quit? What if you're in between jobs and you're not covered? What if your health is not the same anymore? Definitely hit me up, because you absolutely need to have something outside of your job. So you just reminded me of that. Thank you so much, Dr. Karen. I love you.
Thank you. I love you too. So let's